They'll answer all your questions. Yeah, I think that's basically it. So over to you guys. Open the presentation. All right. Okay. There you go.
Hi guys, Satya here. I have Shiv with me.
Good afternoon.
So, like you know, Shiv is our head of legal and also the company secretary, and we both will make our best effort to go over what GST is, um, and what are the basic features, what has changed, what has not changed from the present law and things like that. So, just to give you guys a background. Um, there are two kinds of taxes, right? Direct taxes and indirect taxes in the country. Direct taxes, pretty straightforward, is your income taxes or corporate taxes for companies and things of the sort. So direct taxes, the basic difference between direct and indirect taxes being, direct taxes are levied on the income that you earn. So basically, a guy earning 5 lakhs gets taxed at a particular rate. A guy earning 10 lakhs gets charged a particular rate, gets taxed a particular rate. 25 lakhs another rate. So things of that sort. Based on your income, a guy gets taxed on direct taxes. If you look at indirect taxes, it doesn't differentiate between how much you earn or how much you make. It's basically on the goods and services that people consume in a country or an economy. So basically, GST has been designed towards subsuming all the indirect taxes and getting away with the tax on tax, which she will take you a little bit deeper on. Basically, tax on tax, which was VAT on service tax and things of the sort, out of picture, and making it a pure play indirect tax, which cascades where the benefit cascades from one person to the next. Um, so what we intend to cover are what is the present and the proposed scheme of indirect taxation, what are the features of the proposed GST, a few illustrations to show what the tax benefit can be under GST, what is the IGST model, features of the Constitution Amendment Bill which got passed recently, what is GST net, and how will GST operate, uh, and what the transition provisions are, how will I move from the current era into the next GST era, and then we'll open up for question answers. So I'll let Shiv take this. Both of us will keep talking, and please feel free to send your questions at the end of the presentation. We'll try to address most of them.
Good afternoon. Basically, that present taxation structure is on the basis of, that at present there are taxation called excise duties, service tax, which you are very familiar with, sales tax or VAT or GST. At different level, these are taxable. Example, excise duty is taxable on manufacture, service taxes on provision of services, and so on and so forth. That these are the present taxations. How do we, that in the GST regime, how do we look at the taxes? Basically, taxes are divided into three buckets. One is intrastate taxability, interstate taxability, and import from outside India. Basically, your excise duties and service taxes will be subsumed as a CGST, and local VAT and other taxes will be subsumed as SGST, and interstate taxability, which is CST, so far it is called as CST, will be subsumed as that IGST.
So basically, So basically, everything that we had in the regime of indirect taxes, which was VAT, excise duty, service tax, entertainment tax, and all these central and state levies are going to be bucketed under three different buckets, which is CGST, central GST, SGST, state GST, and IGST, which is integrated GST. So if we remember the tax regime earlier, we were paying excise on manufacture, and we were paying service tax on any services rendered. So these things will get subsumed as CGST, which is central GST. We were paying VAT and entertainment tax, octroi, and these other taxes as either VAT or either octroi or whatever. These will get subsumed as SGST, state GST, and then we were paying central sales tax, which will get subsumed as IGST, which is integrated GST. So your total GST will be a sum of SGST, CGST, and IGST.
Okay. Now there is a third bucket in it, that which is a custom duty. Existing customs duty will continue to be there, and there are that we used to pay the additional customs duties, which will be subsumed as IGST.
So like you guys understand, customs duty is for importing material into the country. To give the local manufacturer the benefit of being on the same plane with a guy from outside, there was something called CVD or countervailing duty, which was charged. So that will also get subsumed under IGST.
Basically, this chart also shows that that what all the central taxes will subsume and state taxes will be subsumed.
So basically, if you read it, it's excise duty, additional duties of excise, additional duties of customs, service tax, surcharges, and cess, which comes under the central taxes. What gets subsumed under state taxes or SGST would be state VAT, purchase tax, entertainment tax, luxury tax, entry tax. All these get subsumed under SGST.
Basically, GST is a destination-based tax. That wherever it goes, that tax also follows. That's a concept the GST is that going for.
So just to give you a background on that front, till now we need to start thinking differently in the GST regime, because till now what was happening was there was a tax on manufacture, there was a tax on trade, there was a tax on service. So if I manufactured something in Bangalore, I needed to pay excise duty in Bangalore. If I traded something in the state of Karnataka, I had to pay VAT in the state of Karnataka. And if I traded something between Karnataka and Tamil Nadu, there was a CST. This will get changed. The entire GST is based on destination or consumption. So the destination in which or the place in which the service or the good is consumed is where the tax will go into. So if I sell something from Bangalore to Chennai, the SGST will be payable in Chennai or Tamil Nadu. So sorry, the IGST will be payable to the account of Tamil Nadu. So what becomes important is the entire GST is based on the principle of supply and destination. So it is a destination based tax, which is why if you were following what was happening with this entire GST or the Constitution Amendment Bill, states like Tamil Nadu, Gujarat, and Maharashtra, which were mainly the manufacturing states, the states which had a lot of manufacturing power with them and a lot of manufacturing facilities with them, they were not very comfortable or they were not very happy with this. However, states like Bihar, Orissa, UP were very happy because they have a lot of consumption happening and the taxes are going to accrue to them based on what they're going to consume. So this is the basic thing that you need to think about because this is going to change the entire way the trade happens and also how things are going to go in the future, because it's a destination based tax. And the next one being it applies to all stages of the value chain, which she will take it from.
Basically, that what happens is that any value additions will be taxed in the subsequent hands. Like example, A is selling it to B. In such situation, that this transaction is on the transaction value basis, that it is taxable. Now B is selling it to C, along that he does a value addition. Any value additions will be subject to tax in this subsequent transactions. As the value chain increases, that as the value chain there is an addition that will be subject to tax. Now next question is that apply to all taxable supplies of goods, that it is applicable to all supplies. Here the concept is, that the earlier regime, if you remember that excise duty is, as I explained to you, excise duty is chargeable on manufacturing, VAT is applicable on sale of goods, and service is applicable on provision of services, etc. Now the new concept is going to be supply. There's a, that if there is a supply, it's not a sale, it's not a manufacturing activity, it is a supply. If the A is supplying it to B, that it is taxable, it is subject to GST. So concept important here to remember is that if there is a supply, there is a GST in it.
So we'll actually run you through a few more scenarios down the line. For example, things like I have supplied to my own warehouse in another state. So that also will be constituted as a supply, and I will need to discharge tax liability on that. So like Shiv said, the entire law frame has been supply. So one thing that you guys need to be completely aware of is supply is the main crux of this thing, and it's destination based. So that is something that as a country, as taxpayers or as Tally, where we go and talk to consumers or customers or even partners, where we are pretty clear that yes, these are the two big things that we need to be aware of. It is supply based on supply and based on destination. So wherever the material or the service gets consumed, that's where the tax incidence is.
You must have heard, that in the newspaper, the GST is a dual. Everybody is saying dual GST. It has a two component in it. Basically, if you are doing any transaction within the state, there is a CGST, that is central GST, is applicable, which is collected by the center, levied by the center. There is a SGST, that is a state GST, is applicable. Both are applicable if it is intra-state transaction. If it is within the state, there are two taxes basically. One is central GST and one is state GST. State GST is collected and levied by the states, and central GST by center collected and levied by the center. Now there is that between the interstate transactions, there is only one tax, that is IGST. That is basically a combination of CGST and SGST. The rate, just to give you an example, if presume that GST rate is 18%, central GST is going to be approximately 9%, that is 50% of the total rate, and state GST is going to be 50% of the rate. It is not necessary that it has to be 50%. As empowered committee decides tomorrow, what should be the rate of CGST or SGST. If that the GST rate is 18%, IGST will be CGST plus SGST, that is 18%. 9 plus 9, 18%. That's how it is.
So basically, if you've been observing what's happening, there is something called an empowered committee of ministers, which has been created. So just to give you one background on this, we will run you through a little bit more in detail, but since we're talking of states and center, there was something called Constitution Amendment Bill that got passed recently, right? So what happened in this Constitution Amendment Bill? Just in basic terms, service tax and excise were charged by the center. So anything on manufacture or providing services, only the center had the power to charge that. Anything on trade, which is basically VAT or CST, the state had the power to charge that. So by GST, since we are giving both state and center the power to charge on the other side of things also, that is center for trade and state for manufacture and service, the constitution needed to be amended to ensure that both center and state had the power to do each other. So which is what the constitutional amendment was. So which is where Shiv said that if it is IGST, there will be a part which goes to which will go to center, a part which will go to state. If it is SGST, it will go to the state. If it is CGST, it goes to the center.
IGST, that there are the import. I told you that that customs duty will continue to be there. Additional customs duty will be subsumed as IGST. Basically, in case of an import of a goods and a services, if there is any tax, the GST is applicable in that case. So that will be an IGST, not CGST or SGST. It is an IGST. And interstate, if I transferring, that Tally is transferring stock from Bangalore to Chennai. So it is an interstate stock transfer. Basically, it qualifies as a IGST. Even a stock transfers will be in GST regime. It is going to be taxed as taxed at GST. Export of goods and services, it will be a zero rated tax. Basically, to say that that they are not saying that it is tax exempted, it is zero rated. The reason is that because we have a concept of input credit, like how do we get input credit in VAT at present regime, that will continue to be there in GST, which we will be dealing in detail in future slides.
So basically, what does zero rated mean? Right now, government wants all of us to earn foreign exchange. I mean, they provide a lot of benefits and SOPs for earning foreign exchange, right? So they want to keep that going. They want to earn more foreign exchange in the country, which is why they're saying, I will give you an input credit, though you are not required to pay any output tax on that. So you will be saying my basic value is X, tax at the rate of 0%. So total value being X plus 0, which is X. So so you're still holding on to the zero rated tax. It's not exempt. Exempt means that I cannot claim input credit. Here I can get the input credit and also a zero rated tax. There are a few taxes which remain outside the purview of GST. Customs duty, which is for getting the material from outside the country into the country, remains outside the purview of GST. So that remains as it is. There are a few things on petrol, alcohol, immovable properties, which are outside the purview. Though petrol, they've said they've not come out with a date when it will come in. Alcohol is clearly outside the purview of GST. So states which were charging state excise duty and VAT on alcohol will continue to do the same. Petrol, at some point of time, again, a lot of lobbying in the government between states and centers is happening as to when petrol will be subsumed under GST. So petrol and petroleum products are again outside the purview of GST right now. Immovable properties, immovable properties is another big area which basically deals with real estate and things of the sort, where a lot of stamp duty and other taxes which the states were earning which the states didn't want to give up. So immovable property remains outside the scope. Entertainment taxes by local bodies. There are a few taxes which municipalities and local bodies in a few areas uh, uh, charge. That still continues to remain outside. There have been a lot of push from the center to subsume even these, but then we'll have to wait on what comes out. But at present, it looks like there will be a few things which will stay outside, and also say tax on sale of electricity, and also stock market stay out of picture.
Basically, tobacco is one product which will attract both GST as well as excise. That's why we have said that excise on petrol product and tobacco and alcohol. Alcohol is completely out from GST. As far as petroleum products are concerned, they are in the GST, but the date of effective date has not been fixed. But tobacco is one thing which is outside the. I mean, tobacco is both GST as well as excise will become. Regarding the rates, that there is a tax neutral rate they'll work out, and on these basis, that rates will be fixed going forward. That the indications are going to be 4 rate structures. One is a merit rate, which is below the RNR. Let's say that going by Arvind Subramanian's report, it is RNR is going to be 15 to 15.5%. And standard rate which he has recommended is 18%. If the standard rate is 18%, merit rate is anywhere between 12 to 14%.
So just one thing on RNR. RNR means revenue neutral rate. So basically that is the rate at which there won't be any plus or minus for the government from what it was earning. So revenue neutral rate is the rate which probably will accrue to about 80 to 90% of the products and services that we are dealing with. There is, like Shiv said, there is something called a merit rate, which will be on essential goods and food items which come under the purview of general public. So that will be in the range of 12 to 13 or 14. I mean, right now, let's not concentrate too much on the rates or work too much on the rates. I think the empowered committee is convening again to come out with what the revenue neutral rate should be. And there will also be something called a special rate, which could be on precious metals, which could be on what we call sin goods. Things like perfumes and things of the sort, which are for the people who have a lot of money, who so they are putting that under the category of special rates, and also the nil rate that we spoke about earlier, which was zero rate on things like what you export.
There's a threshold exemptions, that below 10 lakhs you need not register. That as far as the Northeast is concerned, it is 5 lakhs. There's an exemption for registration also, that where the applicability of GST is concerned. There are 2 slabs, basically 10 lakhs for the rest of India and 5 lakhs for Northeast.
So if your so just to see the population and who we are targeting, anyone above a 10 lakh turnover should get registered under GST. So the population that as tally we can go after as to who needs to be GST compliant is anyone more than 10 lakhs in all parts of the country except Northeast, where it is 5 lakhs.
There's in GST there's a compounding scheme, that people can opt for a compounding scheme. Compounding scheme basically work on, that on your total turnover you pay a fixed tax without giving any details. That's called a compounding scheme. At present regime also in the VAT as well as service tax, there is a compounding schemes which is available. Basically you need, on the basis of your total turnover, you need to pay a certain fixed amount of tax. So you will not get an input credit. That is another features of compounding scheme. Guys who have got a business until 50 crores, 50 lakhs can opt for compounding scheme.
So basically, just going back a little, just thought I'll let you know what compounding means. Generally, anyone more than 10 lakhs is supposed to be registered uh, under GST. There is something called a compounding where you can opt and tell the government that I will pay you an X amount of tax, which the government prescribes, but I will not maintain everything as per what you need me to maintain, but I will tell you my turnover is X amount into X percentage of tax. That's what will be my tax paid. I won't be eligible for input credit, which I'm okay with. So basically, for companies who don't want to maintain a huge, their entire list of books of accounts, and all the paraphernalia that goes along with that, and also seeing what should be my input credit, how much should be my output tax, and things of the sort. There could be a few companies which opt for this compounding scheme, which, like Shiv said, is available also currently in the service tax and VAT era. It is also available in the direct tax area. So if I opt for a compounding scheme, 50 lakh is my threshold for all the businesses that I run.
In GST you need to maintain an HSN code which will be used as a classification. You need not, that in any of their returns which you are filing, you have to give a HSN code. You need not give the description of the goods in which you are dealing with. So as far as the service tax is concerned, it's basically you need to give an accounting code, which there is more clarification expected from the government. How do we give accounting code and things like that? HSN code is available in the, that it's already available, so that's not an issue. Only thing is accounting code, they will come out with a clarification.
So just for a little more clarity on HSN, there are about 170, 180 countries who have signed up together to have something which is similar across all the parts, across all the countries. So, for example, if I have a bottle of water, it will have a HSN code, which will be the same code across all the 170, 180 countries. So this is called harmonized system of nomenclature. So HSN is something that we are already working on in the customs, on the customs side. So there are customs and excise side, which is being extended even to GST. So in GST, they're telling HSN is mandatory after a certain level. So the number of so it's basically an 8-digit code, which is different for different classes of materials or goods, as we may want to call it. So this is something that will make it simpler. This is basically to make it easier for the government or the department to work on analytics and areas of that where they can tell that, okay, HSN code number XYZ, so much was consumed, so much was sold, and things of the sort. So HSN is something that is mandatory in the proposed GST.
In GST, that the two definitions are foremost important. One is what is goods and what is services. The goods is defined as, that all movable properties, including securities, except actionable claims and money. Movable property shall not include an intangible property. So that, that goods is a tangible. Simple definition is that goods is a tangible, service is intangible. That's a concept GST is. Now, service definition is anything except goods, including intangible, actionable claims, renting of immovable property, transfer of right to use. Right to use is that if I have a right to use of any property, it is a service. It's not a goods, or it is not anything else. It's basically, if somebody A has given me a property to use, that is a right transfer of right to use. That there should be a title passed on to me for using it. That is a service. Job work is a service. Non-compete clause, many of the agreements will have a non-compete clause and a fees. So this will be a service going forward. Works contract is that works contract is a one important area. Earlier goods, that both VAT as well as the service tax were applicable. Now they've classified it as that it's a service. A supply of food, catering is a service. So these are the basic definitions. They said that tangible goods is a tangible goods is a tangible intangible is a service and tangible is a goods.
Yeah, like Shiv said in the last this one, uh, anything that can be touched and felt is good. Anything other than goods is services. What is the definition? There will be ambiguities in this. There will be questions around a few things that still need clarity, because there have been a lot of representations and lot of clarifications that are being sought from the department around goods and services. What are goods? What are services? Though we may think that goods and services would not matter since there will be one rate of tax, we still are not very sure. Government could at any point of time can come back and tell that, okay, on goods you pay me 20%, on services you pay me 18%. So a clarity there would really help, and there have been representations around a few gray areas as to whether you want to call something a good or something a service, how would you want to deal, and things of that sort. So right now, from the draft law, it is anything that can be touched and felt is good, anything otherwise is service.
One more definition which I wanted to discuss is that taxable event. When the that the event will have which is liable for tax. So that is an important aspect.
This is one of the most important aspect that we need to deal with under GST. What is a taxable event? Like I said earlier, supply is what triggers off tax. But at what point of time does tax actually does the incidence of tax actually get triggered? This is something you may want to pay more attention to, because there could be many events in the life cycle of a transaction, but at what point does a taxable event get triggered is something that you need to pay attention to.
Now I'll just explain to you. There is a supply which is required. Supply of goods or services is very much required to make a taxable event. If the goods and supplied for furtherance of business is a second, that second leg of the transaction says that it should be supply of goods or service for furtherance of business, that it is for the business purpose. From A to B, transfer of goods is for the business purpose. So they have also dealt with, that where it is, that the example import of services, supply of import of that import of services. That means I get a service from overseas countries, which is a taxable event. But in that case, whether it is for the business or it is for non-business, also that it is a taxable event. That is how we have defined on the top portion of the. Now that further,
just to give you some more clarity of what furtherance of business would mean, there was ambiguity in the service tax regime. For example, we were paying service tax on say employee related activities, but we could never claim input credit on the same, though employee related activity for me as a business, for Tally, for example, for Tally as a business, if I do an employee related activity, say we do a R&R event on which service tax is charged, I could not claim input credit on the same, though it was furtherance of business. But GST has clearly called out telling, okay, if it is for the furtherance of business, yes, you can go ahead and claim credit. So that's the taxable event that happens, and you can go and claim whatever credit that has accrued to you. So that clarity has come in, that furtherance of business is something that you'll need to concentrate.
Now there are two further, that the next leg is that with consideration, without consideration, which all, the supply of goods with consideration, that is sale, it may be transfer, it may be barter. That means, that somebody is giving a material in exchange of B. So that is also there. Exchange is basically, that there's a monetary value in it. 10 rupees worth of, that rice somebody has given me. So whereas I give back, the 10 rupees worth of wheat. So that is an exchange, and barter is, that uh, without a monetary value. So that's a basic difference there. Lease or disposal, that even a lease, if you are giving it in a lease, it is considered as, that supply of goods or services. Or disposal of any assets, that if the manufacturing unit sells its asset, then also the GST is applicable. So this is a consideration, with consideration. Now let's look at it, which all the transactions will still form as a supply of goods or services without consideration. A permanent disposal of business asset, that the company sells its assets to anybody else, there is a GST applicability. Use of business assets, services for a private or a non-business purpose. Like example, a professional who uses, that 80% of his car, which is a business asset, 80% of his car for office purpose and 20% of his car for, that private purpose. So if it is, that if he uses 20% of his car for non-business purposes, he will not get an input credit to that extent. So I'll explain to you going forward how the input credit works also. Supply of goods and services by a taxable person to another taxable person or a non-taxable person in the course of furtherance of business. Example, that if there is a, if the if there is no consideration, A is given some services to B, then, then if it is for furtherance of business, then it is taxable even though there is no consideration.
So if you see, there are, the taxable event could be with and without consideration. So what they're bringing about here is there could be a transaction between two companies based on the relationship that they have. For example, I tell that, okay, can you do this small job work for me at no cost? So even though there is no monetary exchange that happens, the department can come back and tell that there has been a taxable event here, because there wasn't, even though there wasn't any money exchange in that process, there's still been a taxable event. So go ahead and pay me tax on X amount of valuation that they will determine.
Pharma company giving the free samples.
Yeah, for example, pharma companies gives free samples to doctors and things for furtherance of their business. That will become a taxable event. There are clarity which still is required on how will we deal with, say, 1 month free of usage of some kind of internet, for example. So that becomes a taxable event. So a lot of structuring around all these transactions need to be done, but then all these are brought into the ambit of GST. So with or without consideration is something very important to be aware of.
Next is that time of supply. Then we have seen the goods, services, and the supply. What is supply? Now at the time of supply, when I need to charge the tax, that is important. That for the goods, earliest of the following. One is date of removal. If the material, as soon as I remove a material for supply from A to B, that A removes a material, the date of that removal, or making available to the buyers. Like example, that my factory which I wanted to sell, I have given it to B, saying that make use of it, that not make use of it, then you take the charge of that factory from that date. Date of invoice is that as soon as that we raise an invoice, that date. Or receipt of payment, that if I receive the payment, like advance, if I receive from that date. And the third one is that as soon as I account for that, receipt, that receipt of material, as soon as I account it on that day, whichever earlier is the date for that time of supply is concerned.
So basically, it becomes important as to when we recognize when the good has been supplied. So the time of supply is something very important. So like you said, the earliest of any of these things. So if I raise an invoice but do not dispatch the goods, the tax, the supply gets triggered. If I send the goods, it's in transit, the supply has got triggered. I've received a payment from you even before I send the goods, supply has got triggered. So the earliest of any of these things, supply gets triggered. That's the time for supply of goods. For services, again, it's the earliest again of the date of issue of invoice, which we spoke earlier. So even though the service may not have got rendered, if I've issued an invoice for that, it is deemed that the supply has got the service has got supplied. The date I receive payment, if I receive payment before even rendering a service, the supply gets triggered. Supply of service gets triggered. The date of completion of service where invoice not issued in the prescribed period. So if I've completed a service but still not given an invoice, the supply has got triggered. In this case, so you've actually supplied the service, but the invoice has not been raised. And again, the last ones being if you've accounted it in your books. So the earliest of any of these dates. So if you've received an invoice first, or if you've raised an invoice first, supply gets triggered. That's the time of supply. If you've received the money, that's the time of supply. If an advance is received, that's the time of supply. So basically, the law has looked at all the scenarios around when things could happen, and the earliest of those things is when the department wants the tax paid by you.
Now, there's another terminology is a taxable person. Who's a taxable person? Taxable person can be any person who has got a business in India or a state in the state of India and registered or to be registered for GST or SGST or IGST. Basically, anybody who has a business in India or that business in any of the states in India, who is required to be registered, who is registered for CGST, IGST or SGST, is a taxable person. There are some exclusions. As I told you earlier also, your aggregate turnover in 5 lakhs, less than 5 lakhs in Northeast and 10 lakhs in rest of India, you will not be a taxable person. Government or local authorities for a specified activities, if you are only procuring a material, government offices for only procuring a material will not be deemed as a taxable person. Agriculturist will not be deemed as a taxable person. Employees will not be deemed as a taxable persons. Exclusive supplies, you have that particular goods which is your goods or services, you are exclusively supplying it for non-taxable, that it is termed as a non-taxable goods, then you are not a taxable person.
So basically, a taxable person is, I mean, if you think about it in the usual course, in the normal course, anyone who has more than 10 lakhs turnover becomes a taxable person. I mean, this is where I think 98% of people will fall under. In the Northeast, it's 5 lakhs. But if you're doing agriculture, there is an exemption. You're not a taxable person. So agriculture, any agriculturist is out of scope. Employees are out of scope. So even if an employee's salary is more than 10 lakhs, he would not be a taxable person under GST. So that's about taxable person. If you go to taxable value,
basically any transaction value, that at price at which I supply it to somebody is a transaction value. Any amount paid or payable for a supply is a transaction value. Basically, taxable value is always a transaction value, preferably, because next slide I'll show you that methodology of computation of that valuation rules. Basically, then if these are the things which need to be included in the transaction value. If reimbursement of expenses, if you are, then you are reimbursing somebody, that expenditure for the incurred, that is also a part of the transaction value. Royalty or a license fee paid for the particular, that goods proportionate royalty or a license fee is to be paid, that also has to be included. Free supplies, if any, that also has to be included in the transaction value. Any taxes other than GST, all other taxes other than GST is a part of the transaction value. Discounts, that I've added discount in exceptional cases, which we will be dealing separately. That certain prefixed, that predetermined discounts are not added in the transaction value. It is allowed, but after the sales, if you come out with any discount schemes, that will be a part of the, that you will not get a benefit for that discounts. Transaction value not accepted in the following cases is a related party transactions. If that any related party transaction has to be arm's length transactions, that is, that you have to do arm's lengthing there. Consideration not wholly for money, that you have to trigger the valuation rules.
So basically, what are they telling is taxable? Any amount, be it whatever you want to call it, charged for a supply is what becomes a transaction value. This could mean what you may want to call it as a reimbursement. Earlier, we had this this whole confusion around where will reimbursement fall. Do I need to charge tax on it or not, and things of the sort. So they have clearly defined now, telling that you may call it reimbursement, you may call it royalty, you may call it under the name of free supplies. For example, I give 10, for buying 10 you get another 2 extra. You will need to pay tax on the other 2 also. Any other taxes, for example, like I said, there could be some local body taxes, which that will also form a part of the taxable value. So they've encompassed everything, everything which and made that base value for on which tax should be charged. So if 20%, so if I have 100 rupees as the base value, 20 rupee reimbursement and say 20 rupee license fees. So I need to charge on, earlier I used to have this confusion whether I charge on 100 or 140. Now they are very clear. You charge on 140, the 20% on 140, which is 28, and that tax needs to be paid to the government. Shiv was also talking about discounts. There is something they have come out again clearly with. When I am selling the product, and if the discount is predetermined, telling that if you're buying 100 units of X, I will give you a discount of 10%. That can be a part of the transaction value. So you tell that if you buy 100 into 100, which is 10,000, and I give you a discount of 10%, which is 1,000. So on 9,000, I can pay tax. But after charging 10,000, I see that this material is not moving. Okay, I take the decision about giving a discount on a later date, telling that okay, I go to my customer and tell him that okay, can you offer a 10% discount which I'll pay you separately. I cannot adjust that with the transaction value. I will have to pay only on the entire 10,000. I should have paid 20% tax, and this becomes a cost separate for me. I cannot adjust taxes on the discount. So any predetermined discount, yes, they do allow, but discount after sale of the material does not get allowed in the taxable value.
As I told you that there are method of valuation. First preferred method is a transaction value. If you are not able to determine the transaction value, I explained to you the transaction value is a monetary value of the transaction. If that is not possible, then the second best method is comparison value. Comparison value is basically, that goods or services of like kind and quality supplied to other customers, third party customers. If I, that any third party customers, if I've supplied, at a monetary value, then that should be the basis for me to determine the value. If that method is also not possible, then that production based or a manufactured based cost, that will be the method. Then they proposed a residual method, which will be, that empowered committee will decide which method is suitable going forward. As on date, they have not clearly spelled out what is the residual method is.
So we used to harp a lot on MRP and things of the sort earlier, right? Which is going to go away completely now. Now it's clear that most of the goods will fall under the transaction value. So a value at which a transaction happens is what is the preferred method of valuation under GST. If that cannot be done, okay, if an officer at the time of audit or assessment looks at your books and tells that, okay, both of you have colluded together, the buyer and seller have colluded together just to pay lower amount of tax, he can always go back to, he can question the transaction and he can go back and compare, telling that, okay, this bottle of Bisleri costed 10 rupees, but a bottle of Kinley is being sold for 20 rupees. Is 10 the right rate? So you won't want to get there, but transaction value method is the preferred one. If that cannot be done, they go by comparison. If that also cannot be done, they go by compute, and a residual method which will be defined by the empowered group of ministers, empowered committee basically. Now comes the one of the most important things that there are 2 or 3 things this entire law is based on, right? I told you one was supply, one was destination based tax, and the third one is input tax credit. The entire GST regime or the GST law has been created so that there is a smooth flow or a seamless flow of credit, as we call it. Just to give you a background of what input tax credit is, most of us should know what it is, but just in case a few of them don't know. I'm a manufacturer and I buy something from another supplier and I sell it to probably the next person in the chain. What happens is there is a tax charged. There is a tax that is charged on me, and I pay the tax. Do whatever with that material, make it into a something better, or do some value addition on that, and I sell it to another person going forward. Okay, there cannot be a tax. I would have paid some tax. Okay, and I cannot charge another tax completely. And this basically that tax cannot become my cost. Okay, I cannot add that cost and again charge it again to the next person. So basically there cannot be tax at different stages, which is why this whole GST, which talks of seamless flow of credit. So what happens here is, if I've taken material from X and I've taken material for 100 rupees. I've done some kind of a value addition for say 10 rupees. Basically the value on 100 rupees, the tax is already got paid. The value addition of only 10 rupees should suffer taxes, which is what this whole law brings into perspective. So what used to happen earlier was not that there wasn't input tax credit available. There was input tax credit available in the VAT regime, in the service tax regime also. But there was another big thing of tax on tax, as we may call it. There were a lot of clarity mismatches between center and state, because center used to charge on service tax and excise. Excise was quite clear, but state used to charge on VAT. So what used to happen was state wanted also some revenue for them. Center also wanted. There were things like, there were a few things where both VAT and service tax used to get charged. with GST there comes a clarity that there is no tax on tax. So so I could claim something earlier, which Shiv will take you through the different scenarios down the line. So basically the tax on tax. So if my base price was 100 rupees, VAT was 10 rupees, service tax used to get charged on 110 rupees. So that goes away. Here it is one rate of tax on 100 rupees. I will pay 18 or 20% and one tax. So the tax on tax, which was prevalent earlier, will go away, which she will take you through in the coming slides.
Basically, input tax, that there are conditions for ITC credit. You have a limited period to claim, that avail the input credit, that is 1 year as of date. The credit availed on the basis of tax invoice, you need to have a tax invoice or tax paying document issued by the supplier. Basically, he issues a tax invoice to you. So that document is very much required for you to avail the credit. Credit to be availed on receipt of the goods. If the goods is received by me, then only that I will be able to claim the input tax credit. There there is a returns which I will deal with going forward. Returns is that required to be filed, then only I'll be able to take a credit. Tax charged in the invoice has been actually paid. That basically what happens is that when I purchase a material from A, I pay 100 rupees for the material, and let's say that 10% is a tax, 110 I pay him, that is 100 is for the material cost and 10 for the tax. So he need to deposit that 10 rupees to the government, then only I'll be able to take a credit. This is one peculiar system in the GST, that that unless my supplier has paid the tax to the government, I will not be able to take an input credit. So there are few restrictions. The goods and services used partially for the taxable and exempted goods, you have to take a proportionate credit. That if you have used for a let's say that A is taxable at 10% and another B product which I'm dealing with is let's say that not 0% exempted goods. So then I will be able to take a partial credit only. No credit in respect of motor cars. There are exceptions, very few cases, that somebody who is running the transportation business, he'll be able to take a credit, input credit. Otherwise, motor cars will not be entitled for, the input credit. Goods and services for personal consumptions, you will not get ITC, that is input credit. Works contract resulting in an immovable property, like I call the contractor and tell him to construct a factory building, I will not be able to get an input credit. Basically, input credit, that there are three buckets of input credit which is available for any, for the businessman. Basically, IGST credit, CGST credit, and SGST credit. How we can utilize this? Basically, IGST credit has to be first utilized for IGST tax payment. The blue colored ones are input credits. Below that are tax payable. That IGST credit can be first utilized for IGST tax payment, and then if after that that it has to be utilized for CGST, then it has to be used for SGST.
So just to add a bit more here, if you're wondering what is all this IGST, CGST and SGST, there will be credits that will be accumulating on at different taxpayers registrations. Okay, I've done an IGST transaction on which IGST is basically an interstate transaction that I've done, on which there is some credit which is lying. I have done a transaction of CGST and SGST, again based on which there have been some credits lying. So how do I utilize? So basically, by credit, what we mean is the tax credit that I can basically take. There is an output tax that I have to pay on my sale, but I've already paid something on my inputs. So I basically set off between my output tax payable and my input tax credit that I've got. So this could be in the form, like I said, of IGST, CGST, and SGST. These are the things under IGST are claimable under all three, but SGST and CGST are only for those things, and you cannot set off, for example, CGST under SGST. So anything under IGST can be set off in that order of first I pay off IGST payable and with the use of IGST credit, then CGST payable with the use of IGST credit, and then SGST. So if my total tax pay, if I am carrying a 200 rupee IGST credit and 100 rupee IGST payable, I first knock off 100 there. If I need to pay 200 rupees of CGST, first I knock off the 100 from IGST, and then I take the CGST if there's anything available, and then knock it off. So it's in that order basically where how I utilize my credits.
Now let's take.
This becomes important as to what the tax benefit under the current regime is, and how will it look under GST.
Basically, I've taken 3 stream of transactions. One is that input manufacturer sells it to output manufacturer. Output manufacturer sells it to a dealer. Dealer sells it to consumer. You know that it's basically a chain of transactions. But I've split those transactions into that segment wise. That first is an input manufacturer sells it to an output manufacturer. Now output manufacturer, that when input manufacturer raises a output manufacturer a tax invoice, how does it look? Basically his value is 100. I'm assuming that in all the cases it is 10% excise duty, 10% VAT, which is applicable here. Now in the first, if you look at the first tax invoice, that is tax invoice to output manufacturer, value is 100, excise duty is 10, that is 10% of that, and VAT is a 10% again on value and excise duty. It is 11. So total invoices, total value of the invoice which raised to output manufacturer is 121. Now in that the breakup of the taxation is that excise duty and VAT is that the input manufacturer pays to the government excise, he collects from output manufacturer and pays it to government excise duty of 10%, 10 excise duty and the VAT of 11. In the second leg of the transaction.
Guys, just want to check before we move on with the scenarios. Would you have questions that you may want to ask? Should we take a couple of minutes to break, and in the sense couple of minutes to handle questions? Would you want to do that? Yeah, there have been questions flowing in. Let's do one thing. We'll take some questions from what has come, and then we will move on with the different scenarios and what IGST is and how things will look for us going forward. So the first question is from Darshan, where he says VAT was value add, and now GST also. GST also. So
yeah,
what?
Basically, VAT is also a value add in that, but it is within the state. That it can't cross the borders of the states. It is then it is within the state. GST is going to be then it is one India tax. It is across that between the states also you will be able to get a input credit. Earlier in VAT, if you do a transaction within the state only, you'll be able to get input credit. So GST is across India you'll get an input credit. That's a difference.
So basically the thing of one India one tax. Now if you read a few articles, they're comparing this one to how European Union also works. I mean it was a big thing getting all states together. So basically just in the previous slide when we took over what IGST can be used, SGST can be used, and CGST can be used, right? So basically IGST, which was interstate tax, can be used for setting off everything. CGST can be used for the other things. So basically VAT was within the state. What happened outside the state was CST. Now it has become one thing, which is GST. So that's the difference. The next question is, hope we went through that. Okay. exempt versus zero.
Upper one, that it says that he says that can you explain same I think.
Yeah, we are going to go with scenarios. So Darshan, we are going to go with scenarios just after getting through these questions. Okay, then the next one is exempt versus zero tax versus tax free, which we just I ran you through that. So basically, zero tax is the value of the goods plus zero rate of tax. Basically, this is mainly for, like I said earlier, for exports, which will help you take input tax credit, so that you are encouraged to do more exports.
In exempted goods, you will not get an input tax credit.
Exempt goods do not fall under purview of this one, of GST, so you will not get any input tax credit there. Next question from Rajan Sharma. What is the difference between 10 lakh threshold limit and 50 lakh turnover? Per understanding or per what the law says, anyone who has a turnover of more than 10 lakhs is a taxable person.
He is required to be registered under GST.
So the 50 lakh turnover was only in the case of composite that we spoke about. But to be registered under GST, anyone who has more than 10 lakh turnover in all parts of the country except Northeast, which is 5 lakhs, becomes a taxable person.
Basically, that below 10 lakhs is not a taxable person. Above 10 lakhs is a taxable person. 50 lakhs is, that he is a taxable person, but he will be opting a special scheme called compounding.
He can opt. He has the option to go under a compounding scheme, which is there currently also. Next question is from Nilesh. What is non-compete? Nilesh, what happens is there will be these non-compete clauses whereby there would be a few businesses which sign up something telling that, okay, if you are leaving my services, you cannot obtain any service from my competitor, for example. So if that happens, you will have to pay me an X amount of money. So these are non-compete clauses that are prevalent in the market, and if something on the non-compete front happens, that also becomes a taxable event. What happens to GTA and reverse charge for service providers? We'll cover reverse charge in the next few slides, right? So there is a reverse charge which we will cover going forward, Pradeep. Then again, Nilesh asks, what is included as here securities in definition of goods as stocks are outside purview of GST? You want to take it?
Okay, basically stocks are not outside purview of GST. Basically what we are trying to say is that STT, that today there's a tax called,
security
transaction tax, which is applicable. That is, in addition to GST. Security is part of the GST. So there are two different taxes actually. If you look at it, the sale consideration is subject to GST. Earlier it was service tax, now it is GST, and STT is a separate tax which will be continued to live.
Then again, Pradeep asks, if a service provider is providing service on behalf of a brand, will the threshold limit of 10 lakhs apply?
The service provider is...
So he's asking from the present context, okay, of 10 lakhs being the limit for service tax. Okay, if it's a branded service, it starts from rupee 1. Okay, will 10 lakhs turnover be applicable, or the rupee 1 thing will continue?
No, it continues to be, that if your total turnover is less than, 10 lakhs, then, that threshold limit will continue to exist. But if you're in the case of a reverse charge, specifically on reverse charge, what happens is that the threshold limit is not available. In certain cases, threshold limit is not available. So we will be, if required, we will, that sum up and send you a mail also.
So Pradeep, from our understanding now, the threshold remains 10 lakhs. Anything below 10 lakhs, you need not register. Okay, but there has been a little bit of confusion because there have been a few representations around that.
Okay.
We will come back on that.
now there is another angle to it. Today, what is happening is that like Flipkarts and that e-commerce companies, they have to withhold a tax. So that is a different angle to the questions you have asked. That now if I'm dealing with a branded, from the day one I need to pay. Yes, there is an applicability. That the e-commerce companies like Flipkarts are subject to withhold a tax if you do a transaction through them. Next.
So the next question is again from Pradeep. Will GST impact TCS? By TCS, we assume it is tax collection at source. So on TCS front, yes, there is a separate chapter on TCS whereby they are telling that there will be TCS on a few items. Like Shiv said, on e-commerce transactions, there will be TCS. Then they are also keeping their option open, telling that there could be TCS for other things also.
Yeah, basically today they've qualified for the government, that government supplies and things like that. But going forward, they by notification they may add any product or a category or a company, that subject to TCS. So the answer to your question is that there are two cases they have mentioned the TCS. One is on e-commerce, one is on non-e-commerce. Non-e-commerce they have not spelled out in which areas it will be covered. But that they have said only to the government as on now. Going forward, they may notify those cases.
Again, Pradeep asks, will there be exemption for SSI units?
That there is, as on date, there is no exemption for anybody except that that your threshold limit of 10 lakhs.
So
or 5 lakhs as the case may be. Northeast is 5
so
lakhs.
Right now they haven't come out with any exemption for anyone. Though there are a lot of people trying to lobby for a few things. So if your turnover is more than 10 lakhs, you will be under the purview of tax.
But the GST regime, I wanted to say that that exemption is also not good. The reason is that because that the seamless credit will be blocked if any exemptions, like earlier exemptions were there for SEZs and earlier exemptions were there for certain backward areas and things like that, which should not continue in GST regime, because that moment exemption is there, as I told you, that input credit will not be passed on. So the buyers will be in trouble, procuring a goods from exempted units. So going forward, that GST regime, it is a seamless, since there is a seamless credit, all exemptions, most of the exemptions will go away. But still, that maybe SEZ kind of a thing may continue to be there.
Yeah, like Shiv said, I think the most important thing that we need to be that we need to keep in mind for GST is that seamless credit. So when there comes an exemption at some point of time, the chain is broken at that stage, and anyone transacting post that, the tax becomes a cost, and that cost gets passed on to the next level, which is why exemptions are not thought of in the GST regime. From what we know till now, in the model law, there haven't been any this one for exemptions. Just one up here.
Will there be other registration for GST on tin? Will work for the business houses.
Okay, the next question is from Siddharth Haldar. Will there be other registrations for GST, or tin will work for business houses?
Okay, there is a registration which I will take
so there are subsequent slides around registrations. We will take you through those slides going forward. We didn't want it to become too boring for you guys, which is why we said, okay, we'll answer a few questions and then move on. Okay, Ilango asks, how about the input credit on the opening stock to be considered? If so, at what rate? Again, transition provisions will be covered going down the line. So we will take up the transition provisions as to how you can carry forward your credits that are lying with you as on March 31st, hoping that April 1st will be the date when you move to GST, how you can move forward. Sangeeta asks, will one registration work across IGST CGST, SGST, if dealer is pan-India. Sangeeta will run you through that when we're talking on registrations. Will input credit be available on purchase tax liability? Kannan.
There is no concept of purchase tax in GST. Of course, there's in VAT there is a purchase cost. There is a purchase tax. Sorry, not purchase cost. So I hope that is the answer for this. You know that there's a reverse charge, but no purchase tax as such.
So the purchase tax, Kannan, that was there in the earlier regime of VAT has not been envisaged under GST. So we're hoping that there won't be purchase tax. I mean, in the draft model law, which we think that will be most parts of it will be a part of the main law. We don't foresee purchase tax being there. Again, Sangeeta, was VAT not destination-based tax?
We have explained this. You know that the VAT is a destination-based tax, but only thing is that it is within that boundaries of the states. Beyond the boundaries, you know that you will not get an input credit. Whereas in GST, beyond the boundaries also you will get an input credit. Rajan Sharma, how come is 100% coverage?
Rajan Sharma asks, how come it is 100% coverage as in India, accounting is done on the due basis, but GST...
That is a different question.
Oh, sorry.
That is Deepak Tiwari.
Sorry guys.
We have not understood this question.
Rajan, if you can put that question back again, we just see one part of the question which says, how come it is 100% coverage? Don't really understand what that question means. Deepak Tiwari asks, as in India, accounting is done on due basis, but GST is payable on supply. So the date of invoice generation will not be relevant in case of GST calculation on supply of goods or service. Till now, it is taken in the consideration for tax calculation.
We have explained, you know, that when the supply will trigger, you know, that 4 conditions we have said in our slides. So basically, you know, that those are the conditions which, you know, that whichever the earliest is the case. If we will not cover it again because
so Deepak, you need to bifurcate between accounting issues and taxation issues.
Okay.
Government here is coming out with with what taxation is, what GST is, and they are not coming out with how it should be accounted. ICAI, which is the Chartered Accountant Institute of India, is the one which generally gives you which does the combination of tax and accounting as to how the tax should be accounted.
Guidance note.
There is a guidance note which is expected soon. We'll come back on that as soon as we read through the guidance note as to how do you accrue these taxes, though they're paid based on advance or something else triggering that.
GST will not deal the accounting aspects.
Yeah, GST will not deal with that.
How do the, you know, that when the tax is due and how the tax has to be paid.
Okay, next is Hema Malini. How will GST benefit exporters? There is no benefit from what you do things as of today. Like we said, it's a zero rate tax which continues to give you all the benefits that you enjoyed earlier also.
Benefits are available in the present regime also, which will continue. That is the only thing which we wanted to say at this juncture.
Rajan Sharma, like in VAT, there are various unregistered dealers. So same will be in case of GST model for less than 10 lakhs. So how come it will be 100%?
Like VAT,
there are various unregistered dealers. So same will be in case of GST model for less than 10 lakhs.
Yeah, that if the, you know, that if your transaction is less than 10 lakhs, you have an option to register, or you have a, you know, that if you have not registered also, it is legally, it is not wrong. So question arises that why should I register? Because if your, you know, the customer comes and says that I need an input credit, then obviously he will, you know, then he may have a constraint to register himself under the GST regime.
So what happens here is Rajan, even if your tax, even if your turnover is less than 10 lakhs, if a business wants to purchase from you, they would want a seamless flow of credit. But at that stage, if there is a dealer who's doing turnover of more than 10 lakhs and is registered and offers a input tax credit, of course his cost is going to be lesser than yours, because for you the tax that you paid becomes a cost since you cannot pass it on in the future. So which will force you to either register or increase the scope of your business to more than 10 lakhs, which is what we said, that this gives you a complete cascading effect, which is good for the economy in the longer term.
Is there any negative list products and services? Okay.
Okay, Siddharth Haldar asks, is there any negative list products or services in GST like service tax?
Okay. The list of negative list is not there. It is exempted list in this case, or that at a merit list, as I explained, there are 4 slabs which is available. So negative list will not be there, but exempted list definitely will be there. But we have to wait and see, that which product will fall under exempted list, which product will fall under merit list and standard list.
So basically, like you said, there are 4 lists that we're talking of right now. Right now, it is a merit list where we think that all the food items and essential stuff that is needed will fall under. Then the normal list where 90% of your other products will fall under, and then what we call the sin good list, or where the tax is higher. So sin goods like perfumes and things of the sort will fall under that. Right now, there hasn't been anything around the negative list that has been spoken about in the model law.
One question which is Santosh.
There
is any VAT like
okay, Santosh Gawande asks, there is any VAT like GST also for regular or composition of SEZ?
Okay. Basically, question is, I think if you can reframe and send the question, it will be helpful. I'll just that presume certain things and tell you. As far as the the composition which is available in VAT, again it is the same thing. You need a registration and a VAT, but you have to pay a certain fixed tax at that on your turnover. As far as SEZs are concerned, that some of the states have given specific SEZs. They've given an exemption today. Going forward, that we have no clarity on SEZs because industry is also asking for a clarity. They have yet to come out with a clarity on SEZs. But VAT, I told you at present, that it is a SEZ specific, state specific exemptions which is available today for SEZs.
Don't know if that answered you completely, but from what we could understand from that question, we've given. In case it didn't answer, please write back. Santosh, right? Santosh. Yeah, Santosh. Vetri asks, based question on time of supply, date of receipt of payment, will GST be charged or deducted on advance payment or receipt of money? Vetri, per our understanding, yes. It is those 5 things that we spoke about. Whichever is the earliest, so even on advances, there will be a component of VAT, a component of GST, I'm sorry. Right?
What about LTU? LTU is basically, that...
Vijay asks, what about LTU?
LTU is basically, that it's a arrangement by the tax department, that where the large taxpayers are paying the tax.
So guys, LTU means large taxpayers unit. So he's asking, what about LTU?
LTU will not change the GST as such. It is, that it is a procedural aspects for assessments and other aspects, that LTU is formed for large taxpayers. There is a one dedicated center which is called LTU. But GST will not make any changes in LTU.
See, I don't think there should be too many changes because it's only subsuming all the laws. So if you heard the Revenue Secretary speak the day after Rajya Sabha took it, they're training all the 60,000 people. So how they will organize themselves is something to be seen. So the LTU may stay, may not stay, but if it stays, I don't think it will be too different from what we're seeing right now. Balaji asks, in any chance our Tally software cost will impact either increase or decrease? Balaji, it's too early to talk about how we will structure our product, because we still don't know what the rate of tax is at all. The empowered committee is still meeting, slated to meet over the next few weeks to come out with a revenue neutral rate. There have been rate numbers floating between 18% to 22% and all that. So a lot of considerations need to be worked out before we think or we decide to change the cost of our software. So we will keep all of you updated on that front. But let us wait for the rates to get solidified and also the GST law to come out. Mohan Kumari asks, VAT on quantum is applicable in few of the states like Rajasthan, MP, etc. Will this continue even under GST?
VAT on quantum?
VAT on quantum.
Applicable to few of the states. Okay, I told you that that certain exemptions for the backward states, some exemptions were given, which will go away with the GST regime, unless that government specifies and comes out with the new one. But per se, all concessional benefits which are available for the certain part of the states will not be continued, like Diu Daman and all that. That they had some tax benefits, VAT benefits, that in certain places, Silvassa and kind of places, but that will not continue in GST regime.
Rajgopal asks, how is the benefit of duty drawback passed on to the exporters?
Okay, one important aspect is that, like the moment GST is implemented, you need to forget about your knowledge on excise duty and things like that. The reason is that because here concept is completely different. Here they talk only about input credit. Of course, the duty drawback replica is that you have exporters will have a benefit of either to utilize the input credit for some other purpose, or they'll get a refund. In principle, to answer your question, yes, exporters will get the input credit, that refund of input credit.
So it may be called as refund of input credit, which pretty much is what the duty drawback was all about. Raj, I hope that answers your question. Pradeep asks, will CFOM be still applicable for interstate sales? Pradeep, this is a one tax, one India thing. So there won't be any forms exchanged. This is a completely technology-based tax where all your input credits are going to be matched invoice to invoice at the back end by GSTN, which we will run through. So there won't be any forms that we'll be working with at all. All your Form C, Form F, everything will go away. I hope that answers you. What is provision for ITC on capital goods, Kapil Chopra?
Yeah, capital goods per se, that it is not a part of the input credit, but in that in the GST model law, they do specified some places you do get a capital, that input credit for a capital goods. We are expecting, that the industry expectation is that it will be split into, present, the excise duty laws, which says that it's split into two, that 50% in the first year and 50% in the second year. I think industry expectation is that the input credit, you'll be able to avail 50% in the first year and 50% in the second year. We have to wait for the rules for the more clarity.
So guys, just to let you know, as a company, we also had a lot of representations that we made to the government, which is up on our website. You guys, I hope, would have read through BG sir's article on the clarity required on input tax credit. So there have been other representations also that we've made as a company, that clarity we need, or some provisions which we think are draconian to the country, and also some recommendations that we think we thought we could make to the government. So we've done that. Many of these things have been covered there. In addition to a few more things that we thought, for example, capital goods have been covered there. Things around input tax credit, things around registrations, things around free goods, all these clarifications required have been covered there. would urge you all just to read that once, just to understand that, okay, as a company, we are going back to the government and telling that, yes, this is not feasible, or this is a tough thing to do, or this is a good thing, this is a thing that needs clarity, this is going to cause a lot more litigation in the future and things of the sort. So that is available on the Tally website along with VG sir's article. In thing of time, there are a few more questions. What we can do is we'll cover up the presentation which is left, because we still have a few things to cover. Once that is completed, we'll come back to other questions and also hold on and also do the remaining Q&As. Even otherwise, just in case we are not able to complete the whole thing by 5:30, would love to hear all your questions. There is a session planned tomorrow also. So what we'll do is you can always come back and listen and post your questions for tomorrow. There is also a site which we've created, gst@tallysolutions.com, which where you can throw up your questions and we'll try and answer them to the best of our ability, or even try and meet you and give you that kind of clarity from whatever we understand. gst@tallysolutions.com. Tushar is going to send out an email telling that, okay, this is the site, this is the ID where you can come back and pose your questions. So I'll let Shiv continue with the present scenario and how it will look in the GST regime. We'll come back and take questions. I hope Tushar, is 5:30 a deadline, or can we continue for another half an hour? Would 5:30 be a deadline? Okay. So in case another few minutes, we'll try and continue and try and go ahead till 5:45 or so. Otherwise, we are coming back and doing the same session tomorrow. You can come back with questions. We'll try and liquidate as much as possible today. Shiv, over to you.
Okay. We have, that we were talking about some examples: input manufacturers, sells it to output manufacturers. This is in the present. 1 minute. The present scenario is, that input manufacturers selling it to an output manufacturer. Basically, what happens is that he sells a product of 100, paying an excise duty of 10, and VAT of 10%. Again, it is on excise duty and value. Total is the VAT payable is 11. So total he is, that raising a tax invoice to output manufacturer at 121. Next case, let's take it output manufacturer. This is a present scenario, that it is not under GST, it is under present tax regime. Output manufacturers to dealers, his cost is 100. He adds a value, that the value addition is 10. So it becomes, his value becomes 110. The excise is 11, that is 10% on that. VAT is 12 rupees 10 paisa on value as well as excise duty. So total is 133. Now what happens, that in the output manufacturer, he collects 11 rupees from a dealer, excise duty, and pays that he has a credit of 10 in the present regime also. Excise duty is also, that's sen-vatable if it is a manufacturing activities. Beyond manufacturing activities, it will not be sen-vatable. It will have a cascading effect. So basically, excise duty, that he has ITC of 10. So net tax payable by him, by the output manufacturer is 1. As far as the VAT is concerned, again, that there is an ITC available. So 12 rupees 10 paisa he collects from a dealer and ITC of 11. So net VAT payable is 1 rupee 10 paisa. The next leg of the transaction is dealer to consumer. So here the cost, that cost goes up because excise duty is not available, that it is not sen-vatable beyond manufacturing activities. Dealer will not manufacture any of the goods, so he will consume an excise duty. So his cost goes up, that the actual cost is 110, excise duty of 11, so his cost goes up by 121 because he will not get ITC for excise duty since he is not a manufacturer. So the new value will be, that 121 plus 10%, so it becomes a 133. VAT of 10% is payable on that because there is no excise duty. It is not a manufacturing activities. As I told you that excise duty is applicable only during the manufacturing. VAT is applicable during the sale. So the dealer to consumer, the cost to a consumer is 146.41. Please note of it, that we will take you through next slide where.
So basically, there were two incidents of taxes here, which was on manufacture and trade or sale, right? So which will get subsumed as one GST. That's a distinction that we are trying to make. It's important that you understand that yes, there were two incidences of taxes, which was excise duty first on manufacture, which could not be passed on to a trading activity because there was no manufacture. If there was another manufacturer, yes, there was a so the entire stretch of manufacturing activity was vatable. The entire stretch of trading activity was vatable. But at the stage where the manufacturing activity ended, it became a cost for the VAT guy, and then only the VAT portion got the cascading effect, which is what is going to change in the GST regime. Since it's going to be one tax, it won't be two different taxes which are not cascadable. It will be one tax, which is the basic and the most important distinction in the input tax credit scenario that you guys should be aware of.
Going forward, that what will be the GST regime. GST regime, see, transaction is within the states, so there's a CGST and SGST is applicable. I'm presuming that GST rate of 20%, so CGST is 10% and SGST is 10%.
So just to be on the same, this one we presumed 10% VAT and 10% excise earlier. We are adding both of them and telling that there's a 20% tax. But even though the tax percentage overall is same, there will be saving in the GST regime is what Shiv is trying to tell here.
Now, first case is that similar to the earlier case, that is input manufacturer selling it to an output manufacturer. Only difference is that there we have applied an excise duty and VAT. Here we are applying a CGST and SGST. Value is 100, CGST of 10, that is 10%, SGST. See, the only difference is that what happened is that when we apply the VAT, we have added excise duty in the previous case, but here that CGST is not applicable. That for the SGST computation, we don't have to add CGST. So on the 100 only, we'll be computing 10%. So that's one major difference here. So other than that, that it is more or less similar to the previous cases.
So guys, I think this was an important thing, and I hope you guys would have understood. Just in case you need more clarity, you guys can walk into the finance bay, Shiv, Manish, even our other guys like Kaushik or even Manoj and all that. We can run you through these scenarios just in case you need more clarity. But this is an important thing to be understood in this regime. What we've done is we've not even considered anything else because there could be other things that will impact this whole thing of GST. But what we've done is we just considered as a scenario between 10 and 10, because right now if you look at what it is, you could look at 12% excise duty and VAT ranging from 5 to about 14 or 14 and a half kind of a thing. So if you try to compare that with 18%, which is what is being expected, there could be a big up or a down. What we wanted to show in this scenario is everything being equal, everything being kosher, will the impact of taxes be better off or worse off in a GST regime. So we wanted to show that yes, tax on tax is getting removed, and it is a one rate of tax on supply and no more manufacture or trade. So this was basically the thing. So you could play out scenarios in this based on the current rates and how will it impact. What will it be in terms of if I buy a bottle of water now against what if I buy a bottle of water down the line. It could be different in different states, but then we wanted to show how the entire concept works rather than go into specifics.
Okay, the tax invoice to dealer, again, the cost is 100 and value, that he does a value addition of 10%, that is 110. Then the CGST of 10% and SGST of 10%. It's a simple calculation, that total comes to 132. If you look at a dealer invoice to a consumer cost in the previous case, I will just take you through the previous case, it was 146, which comes down to 145. So there is, that since there is no tax on tax, these benefit will be passed on to the consumer. That is what we wanted to highlight this in the GST regime. Okay. I will take you to another scenario where, in between the two states, if the transaction takes place.
So basically what used to be a CST transaction is what Shiv will take you now. So we've considered a few scenarios, one in the present VAT regime, one in a CST regime. So now he'll take you through what is the present CST regime and how will it look in terms of how in the going forward GST regime.
I think the heading you need to read it as interstate. That it is not intra. I think the heading has been copied from the previous listing. It is interstate. It is not intrastate. Because between Bangalore and Karnataka and Tamil Nadu, that kind of a transactions which we are talking about. First leg of the transaction is intrastate. Second leg of the transaction is interstate. Third leg of the transaction is interstate. So that is how we have distributed. That how does it look? Let's look at the transaction one, that is intrastate. Let's say that Karnataka input manufacturer supplies it to a Karnataka output manufacturer. So tax invoice will be, his cost is 100, excise duty of 10 and VAT of, that the VAT again, that on excise duty as well as value. So it is 11, 10, even though it is a 10% value in absolute value, it is 11. So total it will be 121 in the second output manufacturer to dealer. Now what happens is that output manufacturer, he manufactures from Karnataka and supplies it to a dealer located in Tamil Nadu. Let's take an example of that. Now his cost is 100. The value addition which he is looking at is then, that what value addition he does is that 110 he does, the 10% valuation value addition, excise duty of 11 and CST, that between the dealer and output manufacturer, we presume that C form is issued. So at a concessional CST, he will be supplying a material to the dealer. So total cost comes to 132. As far as the ITC is excise duty of 11, he collects from the dealer and he has a credit of 10. So net payment is 1. CST he collects from and pays directly to the government because there is no ITC available for CST. Now dealer to consumer, his cost goes up, as I explained in earlier cases also. Basically 110 is a cost for him, excise duty of 11 rupees which he adds it to his cost, and 2 rupees 42 paisa, that is CST, which is added to it. There is another component. What happens is that in the present regime, when certain states will have an entry tax, moment material is come inside the state, they need to pay an entry tax. Entry tax is normally paid by the user. That one who imports the material into the state will pay. That is why I'm presuming that the dealer pays this 3%. So that will be also added to the cost. His cost becomes 126, 110 to it goes because of the cascading effect. That excise, he is absorbing the excise duty, he is absorbing the CST, he is absorbing the entry tax. All tax put together, his cost becomes 146. He does a value addition for that, that 10% on it. So his value become 139. then the VAT is applicable, then total comes to 152. Next, let's look at GST regime. Here also that that same concept. First leg is intrastate, interstate, and the third leg is intrastate. Again, Karnataka input manufacturer supplies it to a Karnataka output manufacturers. That then the CGST and SGST is applicable, because within the Karnataka CGST and SGST is applicable. So accordingly, he will be paying a tax on CGST and SGST. Next leg of the transaction, output manufacturer to dealer. The tax invoices. Now when you do from Karnataka to Tamil Nadu, as I told you, IGST is applicable, because that it is considered as interstate transaction, so IGST is applicable. As I told you earlier also, IGST is nothing but the combination of CGST and SGST. So I have taken 20%, that is 10 plus 10, 20%. That is how I have taken 20%. So the tax invoice to a dealer, that is a transaction between output manufacturer and dealer. Cost is 100. He has done a value addition of 10%. So 110 is a value. IGST of 20%. That is that IGST becomes 22. So total cost is 132. Now output manufacturers, he has paid, that he has collected an IGST of 22 from the dealer, and his credits, if you look at it, he has a credit of CGST of 10 and SGST of 10. As we have explained in our chart, that IGST credit, that CGST credit can be first taken for CGST. If that is not there, IGST also you can take it. SGST also similarly, then first you have to utilize for SGST as SGST. After that, it is IGST. Here I have considered, that on that assumptions I have considered CGST. That IGST tax will be set off against CGST, and SGST tax will be set off against. IGST tax will be set off against SGST.
So guys, I know it's a little what do you say? A lot of numbers that we spoke. It's a simple thing. It's not too complicated. What we will be doing is the same presentation will be going up on the website also. So if you could read this in leisure and come back with questions either personally or through emails, it will help. It's not as I know there are not a lot of numbers being thrown around which deals with how we're doing it presently versus how will it look going forward. But if you just sit and read through this when this is posted on the website, probably today or tomorrow, it's not that complicated or difficult. It's pretty simple. We just wanted to show that yes, this is one tax, and how will that impact in different scenarios, be it interstate, intrastate, and things of that sort.
Okay. Last level of the transaction, that it is intrastate. Dealer sells it to end consumer. So his value is 110 because he purchased at 110. So he does a value addition of 10%. So it may be value addition or a profit, whichever the way you want, you can take it. So it becomes, that 121. So since it is within the state of Tamil Nadu, then the CGST and SGST will be applicable. So 12 rupees 10 paisa, 12 rupees 10 paisa of both CGST and SGST is applicable. Total cost becomes 144. If you look at my previous slide, the cost was worked out to be 152. So cost here it is 144. So that's a difference which we wanted to highlight. So next thing is that important thing is that below that tax invoice to consumer, that there are component. He has that from the consumer, dealer has purchased, dealer has taken 12 rupees 10 paisa towards CGST and 12 rupees 10 paisa towards SGST. Now he need to pay after setting off his ITC. He has a ITC credit of 22 in the previous transaction. If you look at it, it is 20. He has a credit of 22. How he takes is that, that I told you that IGST first utilized, IGST credit should be first utilized for IGST, after that CGST. then then SGST. So on that, IGST is not there in this transaction, so I have taken it as CGST first. 12 rupees 10 paisa has been utilized out of 22. 12 rupees 10 paisa has been utilized for CGST, and after that that whatever the residual which is adjusted against the SGST, net 2 rupees 20 paisa he has to pay for SGST.
So, like I said, just run through the scenarios at leisure and come back with questions. So, what we spoke till now was the overall GST law. So, basically, what will happen is there are three things that we've been speaking about: CGST, which is central GST; SGST, which is state GST; and IGST, which is the integrated GST, integrated goods and services tax. So just to be on this, just to be on a frame, your CGST was what earlier what we used to deal as excise and customs. Sorry, excise and service tax. SGST would be what is the VAT, entertainment tax, and all the state taxes, and IGST is the CST, SAD, that is special additional duty, CVD, and all that stuff. So what are the different laws that will get passed? One will be the CGST bill, one will be the IGST bill, which will be passed in the center in the parliament, and the specific states SGST bill in the specific states. So Karnataka will have a Karnataka SGST, Tamil Nadu will have a Tamil Nadu SGST, and things like that. So from what we spoke till now was from an overall frame, and now there are some provisions about IGST which we thought we'll take you through. We'll run them through a little faster because we've already run out of time. We'll try to cover it as soon as we can because we still have things around GSTN, GSP, and many other areas that we want to speak about also. So Shiv, if you can run through IGST soon.
Yeah, basically IGST is again that GST then it's a destination based tax, consumption principles. Basically GST that like all GST, IGST also consumption based and destination based. The important aspect is that place of supply rules. Here it will determine whether it is that transaction is an intrastate transaction or interstate transactions. So in IGST they have something, they come out with place of supply rules. Other than that, in these slides, basically IGST is charged, as I told you, combination of CGST and SGST.
So what happens is in an IGST transaction, let's presume the tax rate is 18%. What happens is if the material is going to be supplied from Bangalore to Chennai, that becomes an interstate movement of goods. So which means that there is a IGST which needs to be charged. So on raising an invoice on say 100 rupees, 18 rupees would be the IGST that would be charged. At the back end, there will be a place of supply, which is basically where is this material being supplied to, which is say Chennai. So at the back end, when we say that this material is supplied to Chennai, a part of that, we don't know what part. Let's for ease, for the sake of making it simple, assume that 50% goes to the consuming state. So at the back end, there will be a 9 rupees of that 18 rupee tax credited to Tamil Nadu, and 9 rupees which goes into the entire 18 rupees goes into the kitty of the central government, and 9 rupees will be credited to Tamil Nadu, 9 rupees will be kept by the central government. So that's the place of supply. So since this was supplied into Tamil Nadu or Chennai or Tamil Nadu, this 9 rupees stays in it goes to Tamil Nadu's kitty. Though when the transaction happens, the 18 rupees will be paid from Karnataka, but nothing accrues to Karnataka. It will all go to a part will go to Tamil Nadu, and a part will go to the center.
It's basically a destination based, that when the goods, let's presume that goods moved from one state to another state, tax also moves from one state to another state. That's a concept. place of supply rules is an important aspect as far as the IGST is concerned, because IGST, that which determines whether the transaction has been taken within the state, and CGST and SGST is applicable, or if it is outside the, that between the two states where IGST is applicable. In case of a goods, they say that location of the goods where the movement terminated for delivery of recipient, because a goods which travels from Karnataka to Maharashtra via let's say that that for example it travels via Andhra Pradesh, so goods starts its journey from Bangalore to Maharashtra and terminates at Maharashtra. It's an IGST between Karnataka and Maharashtra.
So even though the goods moved via Andhra Pradesh, right now what used to happen was we used to have these checkposts. This entire concept of checkposts will go away. It will become one India, like I said earlier. So even though it moves, even though the material moves between states, nothing will accrue to those states, but only to the consuming state. So in this case, from Karnataka to Maharashtra will get the credit of tax. Though the tax may be paid out of Karnataka into the central kitty, a part of it will go to Maharashtra. Karnataka and Andhra will not get any benefit out of this transaction.
Now, the next concept is in the goods itself, that let's say that Hindustan Lever gives an order for a small SSI unit to deliver certain material. That SSI unit is situated in Karnataka, unit of Hindustan Lever, which is also situated in Karnataka, and he gives that instruction to SSI unit, supply a material, the soap manufacturing material to my ancillary at Tamil Nadu. So what happens, that the transaction is basically between Hindustan Lever and SSI unit. Even though the material has moved from Karnataka, from Karnataka to Tamil Nadu, here what happens is that bill to ship to concept comes in, that the transaction, I'll explain only the transaction between Hindustan Lever and SSI unit. Even the material is moved to Tamil Nadu, it becomes a local sales SGST. The reason is that because it is on instruction of a Hindustan Lever, the material has moved to Tamil Nadu. So SSI unit will invoice and raise a tax invoice to Hindustan Lever, stating that that it is a SGST and CGST is applicable in this transaction because the transaction is presumed to be taken place inside the state. Okay, these are the two concepts as far as the goods is concerned. Now let's get into a service. That the service is that location of recipient of service where address is on record. Like I have a recipient's address, then it is a location of the recipient. If I have no address of the recipient, then what happens is that location of the supplier itself will become the the place of supply.
So just in case I don't know who I am giving a service to, which could be in some cases, I don't know who the recipient of that service in all probability would be. Then my address becomes the address for the place of supply is what Shiv is trying to tell. So we can deal with these intricacies if required. We can have one-to-one sessions or one-to-many sessions where we can run through a lot of such scenarios and use cases. We will try and do a lot more of these sessions around these things going forward. It will help to hear questions from you guys so that we know, okay, these are things that are of most interest, and we can organize a few webinars or even one-to-many sessions around this. Just a couple of minutes on what got passed, which is basically the constitutional amendment bill, which yesterday was also passed in the Lok Sabha. I told you earlier that the levy of service tax and excise was the prerogative of the center, and VAT and entry and entertainment and those taxes were at the prerogative of the state. which what the Constitutional Amendment Bill did was it gave each other the power to tax on the other things. So which is what has got passed. And what will happen next? This is the basic feature of this. I mean, won't get into too much of detail here. There has been a lot of press coverage on this whole thing. Basically, what it also provides is that there is a GST council which will be formed, which is pretty much the empowered committee that we've been talking right now. So they will be called a GST council, um, which will be consisting of ministers of the state, the union finance minister, the minister of state for revenue, um, these are the guys who will form the quorum. Decisions should be at least 75%, and the weightage of votes would be 1/3 for the center and 2/3 for the states.
What the GST council can do, they can fix the tax rate, they can fix the exemptions, they can fix the threshold limit, they can fix, that band of rates, as I told you, 4 bands. They can, that they can pass a model GST law and procedures. The rules can be passed by the GST council. Then if there is any special provisions, you guys have been asking that as the SEZ exemptions are there. So GST council will look into all those aspects.
So basically, the central finance minister and the state finance minister holds the key for the entire GST, for the entire constitutional amendment. So the entire GST bill would be at their prerogative, in the sense that whatever, because it's a case of putting one guy putting his feet into another guy's area, right? So states were very clear with what used to happen with VAT. Center was very clear with what they used to get on excise and service tax. But now we're making it one tax, and so we're giving each other the powers. So it is only good that both the guys who are involved in the revenue, state finance ministers and the central finance minister, be a part of this empowered committee or the GST council. So they will decide on what the rates, what is it that states like Tamil Nadu and other manufacturing states that are going to lose. What should be the compensation? How should they deal with reimbursing that entire amount? Would that be for 5 years? Would that continue for more than that, and things of the sort? Just a quick review on the back end and how things would work on GST. There's something called GST network or GSTN that has been formed. Basically, that is again it's a non-profit company, or what we used to in the earlier regime called Section 25 company, or in the present Companies Act called Section 8 company, which has been set up with participation from private parties like HDFC Bank, ICICI Bank, the states, and also the center. All of these guys have come together and made a Section 25 company called GST and GST Network. What is this company supposed to do? It is supposed to enforce, guide, implement, and all processes and maintain GST servers and ensure software integration. So when we're talking of GST, being non-paper, completely based on technology, you need to have a really robust back-end systems to provide this. Just to give you an example, this entire input credit that we've been talking about, unless two of us, like say Shiv and I transact, unless Shiv goes ahead and uploads his invoice and I sign off telling that I've received it, that transaction would not get complete under the input tax thing. So all these things have to happen in the background, which is what GSTN is enabled to do. They have, I mean, the entire operations, entire input tax credit mechanism and the entire GST collections, payments, everything is based on what GST can deliver. So it's a system that is being designed really well, so that the entire infrastructure of the country can stay there.
Basically, GSTM is a 5 operational framework aspect. That one is the registration they do. There are some forms to be uploaded, which we will deal in the next slide. And that some returns need to be filed. So those returns, the payment of tax and annual GST returns and reconciliation.
So basically, registration, returns, payments are the main things which can happen only online. So one difference between what used to happen earlier and now is this can happen only online, and which is going to change the way all software providers, everyone's software providers business is what it's going to change, in the sense that everyone has to change their software to match up with what is the requirement of GST.
I think registration is basically, that there are
so basically, what needs to be registered, how it needs to happen is what she will take you through now.
Basically, that there are quite a few documents which requires to be, that you need to upload in the GST portal, that is through GSTN. These are, that your company specific information, certificate of registration. PAN is an important document as far as the registration is concerned. Your TIN, SIN numbers and communication email IDs, mobile numbers, etc. So what happens is that GST portal, if you do it, that particular state, you have to make one application and you have to insist for CGST and SGST registration. And if you are interested in an IGST registration in Karnataka, you have to you have to apply for IGST registration also. It's a one, as of now, it is going to be a one application. So basically, registration are 3 registrations, the CGST, SGST and IGST. One state, that you have to have, if you require an IGST registration, you can take for IGST registration. If it is not required within the state of Karnataka, if you are dealing, then CGST and SGST registration is required. So it is an application for per state, that if you want Tamil Nadu and Karnataka, you have to make a separate application. For Tamil Nadu, you have to make a separate application for Karnataka. So if you have a multiple business verticals, then you need to have a separate registration for that particular verticals. That you have a stream of business, 2 stream of business, then it is considered as a 2 verticals. So you need to have a separate registration. Threshold limit, the 10 lakh limit which we are talking about, you have an optional registration. If you are interested, you can go for it. PAN based 15, they call it as a unique identification number, which is a PAN based number. It is a 15-digit number. So these are the aspects of registration. See, I'll take you basically, how the GST return works. What happens is that for the month of, let's say that for the month of June, I need to file a return, first return, GSTR on, the 10th of the next month. So July 10th for a June transaction, entire June transactions, GSTR 1 is a output supply, that is your sales. You need to upload by 10th of the next month.
So basically, any company needs to be aware of 3 returns that needs to happen on a monthly basis. For every transaction that happened during the month, by the 10th of the next month, GSTR 1 needs to get uploaded. GSTR 2 would be the inward supplies that I would have got based on the input credit basically that I am going to claim. Generally, this would be an auto-populated one, which happens at the back end from the GSTN servers, and this has to happen by the 15th. So the GSTR2 for me would be GSTR1 for someone else. GSTR1 for me would be GSTR2 for someone else, and GSTR3 would be the total of GSTR1 and GSTR2. So I would have had a 100 rupee tax payable on the outward supplies that I've made, and 80 rupee tax credit that I've got on GSTR2. GSTR 3 would show that 20 rupee tax payable, which would be the GSTR 3.
One more thing which I wanted to tell you is that GSTR 2, that it is an auto-populated. As GSTR 1, somebody else has supplied to me, that when he uploads a GSTR 1 on 10th, on the 11th, it is, it will be visible for me that what all the, the sales he has made to me. If there is something is missing, I can add it, and he has to, that my supplier has to accept that. If he has done a wrong, entry in that, I have an option to delete. Again, it has to be accepted by a supplier who has uploaded that information. If the value is wrong, that any addition, deletions, we can do it in the GSTR2, and again it needs to be uploaded on 15. GSTR3, as Satya has told, it is a combination of GSTR1 and 2. It is auto-populated. End of, that by 20th we need to file this. Basically, that we have to pay the tax also on 20th. As I told you earlier, that without I am paying a tax, that my supplier will not get an input. So that is an important aspect as far as the GST is
So
concerned.
basically, the article that Vijay sir wrote revolved around this whole thing of input tax credit, where he spoke about waiting till the 20th of next month for making the tax payment. So if you could relate that article to how you need to file returns, it will be easier to understand what he was talking about in that article. So the rough estimate is that there will be 9 million people who will be filing returns, of which at least 6 million they think should be filing returns in the first or second month when this system goes alive. So the entire 6 million cannot hit the GST and servers. So what they're proposing is there is a concept of GSP, which is GST Suvidha Provider, who will be aggregating and providing a secure pipe between the GSP and the GSTN network, just to be safe and secure, because the GSTN servers are going to hold humongous amount of data from the taxpayers across the country. They don't want to. They don't want it to be open and exposed to malware and things of that sort. Which is why there is a concept of GSP which comes in, who will be tasked with giving the secure connection into GSTN. So it could be so this entire transaction will probably will happen through GSP and terminate at GSTN. So so we have apparently we have time till about 6:15. So we will continue. And if guys, if you have other appointments, you could drop off, but we'll continue and try and complete this thing. Tomorrow we will, like I said, schedule for 3 hours just to ensure that we don't hurry up and we pretty much try and take all questions. So we will, right now it's 5:50. We will still continue for another 20 minutes and complete the presentation and also try and address as many questions as we can. So I presume the GSTN, what GSTN needs to do, what GSP does, and how the returns are going to be uploaded, and what comes back, and how will the entire reconciliation happen. That frame is, I hope it's clear. We can take you through that again in case someone is not clear. At a late, I mean, when we're running through questions, just drop us a question just in case we ran something, we ran fast on something, or something wasn't clear. We'll try and provide as much clarity as we can. So moving on, there are a few more things that we wanted to run. There will be 8 GST forms: GSTR 1, 2, 3, 4, 5, 6, 7, and 8. Basically, one, like I said, is on the output tax. 2 would be on the input credit that I can take. 3 would be a combination of 1 and 2.
It's a monthly return.
It's a monthly return.
GSTR 4 is a quarterly return for compounding taxpayers.
So like I said, there is a concept called compounding or composite.
GSTR 5 is a, that for a non-resident foreign taxpayers, that in this case, foreign taxpayers also temporary registration in case if they want to do certain business, like example, the foreign company coming and running an exhibition here in India. So they need to, that tax is applicable in any of their transactions. They can take a temporary registrations. Their periodic return is called GSTR 5. GSTR 6 is, that input service provider distributor. Basically, that corporate office receives all material and distribute it to various.
So we did not run through what ISD is, input service distributor. So what I may want to do is, for example, let's take the example of Tally, where I want to buy at one place and pass on input credits to my different branch offices, for example. So there is that concept of ISD or input service distributor, where I can go ahead and purchase at one place and distribute the credit respectively to the different branches. If I have a branch in Tamil Nadu, a branch in Andhra, a branch in Delhi, I can go ahead and tell that, okay, I take the credit here of 100 rupees. I want to transfer 20 rupees each to 5 different places. The concept is that since I'm going to be invoicing or paying output taxes from those places, if I'm doing transactions there, I can use that credit in those respective places. That's the concept. But I may want to do my purchases at one place just to ensure that I get good deals. I don't lose out on bulk deals and things of the sort. So normally big organizations, say Tatas or Reliances of the world, would want to do bulk purchases in one place to get economies of scale and better deals. Once they do that, since they can go ahead and transfer out credits within their own group, that is ISD or input service distributor. That is form number, that is
GSTR 6. See, basically, the ISD is used for, the common pool of services like housekeeping services, that company takes on the corporate and, that ask somebody to take, that portion of the services in the branch also.
So basically, I sign up with one service provider, but he provides me service all over my branches. So I transfer the I want to push out that portion in those places. That is the input service distributor.
Right. Basically, it should not be confused with the material transfers. That it's not that material procured in Bangalore and distributed and ISD, which normally gives. That's a rare scenario. GSTR 7 is that that tax deducted at source. As we have told, that two cases the tax deducted at source is applicable. One is with the e-commerce company. If somebody is dealing with the e-commerce company, that anybody transacts through e-commerce company, then they, that e-commerce company is required to deduct a tax and deposit with the government. So that is one tax deducted at source. Second tax deducted at source is that there is a provision. Today it has been defined for government organizations, that they need to deduct tax. Going forward in the notification, they may extend the scope of this provision.
So basically, there has been a lot of pressure on the e-commerce companies. So what they're saying is, on any transaction that you do, that a commerce company, that an e-commerce company does, a certain percentage should be collected at source and deposited with the government within an X period of time. So if you or I buy say a cell phone, there will be a component of GST in that. There should be something called a TCS, which gets deposited with the government within an X period of time, which is I mean, since the entire marketplace rules have come, since the entire marketplace thing has come, it makes it very difficult for these guys, which they have been trying to lobby also. So that's the GSTR 7.
GSTR 8 is an annual return. Annual return is basically combination of your monthly return. A 12 monthly return is auto-populated. Whereas here you have to do, you have to take it to your financials and compare that. What is my total turnover? What is my taxable turnover? What is my export turnover? What is my, that exempt turnover?
So basically GSTR 8 would be an auto-populated one, which gives you a view of the 12-month transactions, all your GSTR 1s, GSTR 2s, and GSTR 3. Basically, was there any payable, and if that has got paid. So this would that should generally tie up with your financials, and also it will make it easier for an assessment to happen, because an assessing officer need not look at 12 different monthly returns, though technology enables you here to square off everything on a monthly basis. So basically GSTR 3 on a monthly basis would be enough to tell that, okay, my entire transactions are here. But GSTR 8 gives you a view of the 12-month transactions. So these are the 8 GST and GST forms that we spoke about. The dates that we have told you earlier, most of the companies, like I said, will have GSTR 1, 2, 3. GSTR 1, 10th of the 10th of the next month. GSTR 2, 15th of the next month. GSTR 3, 20th of the next month.
GSTR 8,
which is the annual return, would be the 31st of the following year. So for year ending, say March 2018, it will be December 31st, 2018 when the annual GSTR 8 would be filed. We can move on. One more very important thing is that I think we need to understand from the present scenario to what it's going to be is there is no provision or there is no procedure for revising the return. We are all used to revising returns, be it on the direct tax front or the indirect tax front. There is no question of revising returns. Otherwise, the entire premise on which the technology is built here would just fall flat. Which is why there is no question of revising the return, but transactions which need to be revised can only be revised through debit notes or credit notes. So if both of us have signed off on a invoice telling that it's logged, telling that, okay, I've supplied something to Shiv and Shiv has accepted it, that transaction is complete.
No human interface.
There cannot be any human interface into it telling that, okay, it should have been the invoice, what we uploaded is for 1,000 rupees, but actually it was only for 100 rupees. The 900 rupees that needs to be corrected can only happen through a debit or a credit note, which again has to be accepted by both of us. So department is not allowing or the technology will not allow us to file any physical forms to tell that, okay, this was a mistake, we need to get it rectified. It can only happen through debit and credit notes. Okay, I think this slide we've covered pretty much. One more important thing is transition provisions. Basically, I think there was a question around transition provisions as to how will the migration happen, how will the tax credits from the present regime be carried over to the GST regime. That's something that as Tally we need to know, because most of our, all our guys who are there on the present regime will be under the excise, VAT scenarios, and excise, service tax and VAT scenarios. And how will they move over to the new regime? What will be applicable? How will they carry forward their credits? What can be carried forward? What cannot be carried forward is something that is important to know, and she will take you to that.
Basically, that as far as the registration front, that the existing registrations will automatically registered as a GST registers. That first we will get a provisional registration, and then it will be a final registrations. Input credits, that as on 31st March, whatever the input credits are available, which they can make use of it in the GST payments also. There are certain restrictions, basically, that state-wise input credit should be available in that particular state, and in the GST regime, that particular item should be taxable. All that conditions are there, which subject to that, input credit per se is available for businessmen to take in the GST regime.
So whatever input credit that I have carried forward, except for a few things which we can provide clarity on, we've not gone into details. Most of it is transferable to the GST regime, which is why it is good to have a clean opening balance, which also means that as of March 31st, you should have a clean closing balance to tell that, okay, this is what it is. Though I can take it, though I can open, I can tell that this is my opening balance. It will be good to, in case of litigation or a taxable or a tax officer coming back and telling that, okay, this is not okay. It will be good to have a clean closing balance which can be triangulated and carried forward into the GST regime. Okay. So we are left with 10 more minutes. We'll try and if you can start putting questions, if you already haven't, we can run you through. We can go through that. We'll start off from where we had stopped, and if something is left over, we will surely get back on emails. Like I said, you can always write to us on gst@talysolutions.com. So Rajan Sharma comes back telling that in continuation of 100% registration, but it means it is not forced by department for registration, but in the hand of dealer under 10 lakhs to go for registration or not. Yes, 10 lakhs is the limit, Rajan. Yes, 10 lakhs is the limit threshold that the government has set for registration. If you want to register below 10 lakhs also, you can go ahead and register. That is not a issue at all. But if you the moment you reach 10 lakhs, it makes it compulsory for you to register. Less than 10 lakhs, there is no issue. You can still go ahead and voluntarily register. Hema Malini, who is left, asks how would particular transaction of goods and services tax simultaneously under CGST and SGST?
Particular transaction of goods and services be taxed. Okay, now any supply, see.
So her question is, how would a particular transaction be taxed simultaneously under CGST and SGST?
If there is a supply of the goods or services, that is the first leg of the transactions. I explained to you earlier also that supply is an important aspect here. If there is a supply and it is for consideration, in certain exceptional cases it is for no consideration also, it is deemed as supply, and it is for the better, the furtherance of business. If these conditions are there, it is taxable. So basically any supply, it is not necessary sale, it is any supply is subject to tax.
Amudan says, Amudan asks, what will be the impact on our product online and physical?
Okay, now, okay, this is an important question. That what happens is that as we said that tangible and intangible software per se, they are classifying it as an intangible, which is subject to service tax. Now, yeah, subject to service tax. GST is subject to GST as a service, and yes, there is a question.
So basically, I'll take this question. So basically, what will happen is, for example, on things like TNS, where we're paying both the VAT and service tax, we'll only pay GST. On the physical CDs, we used to pay excise duty and VAT. We'll continue to pay only GST. On downloads, which is basically virtual virtual licenses, we used to pay service tax. We'll continue to pay GST. Next question from Santoshi Devi. CVD and cess will be retained or it will be replaced by IGST. CVD, SAD and cess will be retained or it will be replaced by IGST. CVD is countervailing duty, SAD is special additional duty. So both these duties are, like I said earlier, they are charged on an importer just to ensure that my local manufacturers are not they don't lose out. So these will be charged as IGST, but they won't continue as CVD and SAD. Only the customs duty, which was earlier charged, will be continuing as customs duty. SAD and CVD will become IGST.
As I understand, I think the cess will continue to be there because at present, that whatever the cesses are there, inclusive of that rate, they'll come out, or it is excluding that they will come out. We are not sure about it. But there are some states which are imposing a cess. There is an indication that that cess will continue.
Okay. Then Rajan Sharma says, as per intrastate trade of goods, dealer to consumer, there is a difference of 1.21. Does that mean dealer who is dealing with consumer and collecting tax on this stage
offline this question
will not be able
to send a mail.
Rajan, what we'll do is we'll send you a clear working on this, in the sense that like I said, if you can see the presentation that will be uploaded, it will be clearer to you. We will also send you working on this front, because talking numbers on the webinar will be a little difficult. We'll send you that stuff personally on your email. Pradeep Baumik asks how even E2 transactions will be handled in GST regime.
Okay, even E2 transactions is, that the concept of even E2 transactions will not be there. But however, I told you that, that the bill to ship to more or less similar case, which we explained, that the person who has been, that the Hindustan Lever example I gave you, basically Hindustan Lever and SSI unit is, that transacting in Karnataka, and Hindustan Lever instructing somebody to supply in Chennai, it will become a Karnataka sale. I explained to you on this thing, and if more clarity is required, we can, that explain to you personally also.
Nishikant Gupta has left, but he asked the question, what about FOC, that is free of cost billing in GST regime? Do we charge tax part in invoice only? Yes.
Basically, it is going to be a transaction based tax. However, it is, that bifurcation, that your transaction value you have to indicate, and you have to, that all reimbursements expenses will be your cost.
So just to answer in one line, yes. Jaya Acharji says, when Tally will be ready with GST model? I think Tejas will have an update on that. I will pass this question on to Tejas. He will have an update when he comes back next. But just to give you a thing, Jaya, we don't have a choice. We need to be ready, and with the GST module, and we will keep giving you updates regularly on this as to when we will be ready. Again, she has a question. What is nil rate in GST rate category? I told you earlier, there is a beneficial rate, there is a normal rate, and a nil rate. Basically, nil rate is for goods and services on which you want to still encourage sale of those goods. For example, exports, where you're allowing an input credit, and also telling that the rate of tax is zero. Because if you make it as a exempted goods, and exempted goods, there won't be an input credit that you can take, because there won't be any output. So which means that you still want to give this guy the input credit, and also encourage him to do his transaction. That is nil rate or zero rate. Ratna but Jani, she is left. She asks, this means during transition we would be able to avail credit of service tax against VAT credit, or it would be consolidation of both. Will it be transferred to IGST credit? So basically she's asking the VAT credit, will it be?
Okay, if the state credits, then VAT credit is likely to be SGST credit, and if you have, that center that is excise duty and service tax will be a CGST credit, and your CST will be IGST credit.
So basically, like I said earlier, you can I mean, these things have got subsumed into the things that we said. Your service tax and central excise have got subsumed into CGST. So if you have a credit there, that will pass on to CGST. If you have a credit in the different states for VAT, that will get subsumed into SGST. And if you have a credit in your CST, there's no credit in CST.
CST there is no credit, but you may not get.
Yeah, that won't be there. So IGST will be a clean slate.
Okay. There is a small confusion between IGST and CGST. Again, Ratna Bhatt. Basically, IGST is that between the two states, that is Karnataka to Tamil Nadu, IGST is applicable. If it is within Karnataka, CGST and SGST is applicable. So I hope we have clarified that point.
I mean, Ratna can come back and I mean, if you need more details, you can always come back and spend time with us. We'll run you through to make you clearer. Santoshi Devi asks, who will utilize the credit in case where the place of supplier is considered as place of supply?
Who will be utilized the credit? See, basically the credit will be utilized, by taxes paid by this is in the case of service supplier considered as place of. Okay, place of supply rules. Example, if the material is moved from A to B, A to B, then what happens is that B pays the tax and B takes as an input credit. The seller, the receiver of the material is taking an input credit. He pays the tax and takes an input credit.
I hope that answers Santoshi. Rajiv Rathod asks, if the businesses decide to go for threshold limit for GST payment, how will the suppliers get the tax credit?
If it is below 10 lakhs, he has, the unregistered dealers, you will not get. Anybody supplies unregistered dealer supplies a material to you, you will not get an input credit because there is no tax, there is no credit.
So anyone who's registered can pass on the input credit, Rajiv.
What is ASP?
So what is ASP, Siddharth Haldar?
In the GST,
ASP, I presume you're asking it from that slide of GSP, ASP, where we went through GSTN. ASP would be application services provider.
Like Tally.
Yeah, like Tally, SAP, or whoever it is. Dilip asks, does a retailer need to upload every sale transaction done to an end customer?
Yeah, required to be done on every transaction needs to be done, but the details will differ, that case to case basis, that B2B transactions, you need to upload all the transactions on a case to case basis, like invoice wise, you have to do it. In B2C, there is a threshold limit, that
there are
various threshold.
Basically, there are rules around this. Forms around this as to what are the different fields that you need to fill for different categories. So, for example, for a B2B transaction, for a composite, for a guy who is in composite, for a dealer who is doing interstate, intrastate, everyone, it's been prescribed. So that is available on the public domain. We can just share that with you as to what are the things that needs to be done in the different forms. So it's basically it's clearly defined as to what needs to be done. Naveen asks what happens to cess like KKC, Krishi Kalyan cess.
We are expecting a consolidated rate, that's what it is. We presuming that cess will not continue. One rate will be there, but we have to wait and see, because in the state they said that cess is outside GST. So we are not sure about how the GST rates of GST will come out.
So the rates are still not clear. Like I said, we need to wait on the empowered committee or the GST council to come back with that. Let's just wait on that. In the next few weeks, I think there will be clarity around that, Naveen. Santosh asks, how can manage abatement for specific services? How can we manage, is it?
Yeah,
Okay.
which,
I think he's asking about abatement which was available in the excise regime.
Yeah, that's now GST regime. That there are only two. One is that you will be pay input credit. You will pay the tax and take an input credit. One is on the reverse charge. There also input credit is available, because if you import some services, then you have to pay on the reverse charge methodologies. For more clarity, we are also waiting for the rules, draft rules to come out. So some clarity will prevail.
Guys, Pradeep is telling we're running out of time. There are a few more questions, I think 4 or 5 more, because he has another session starting in the next 5 minutes. And we will try and address these questions tomorrow, or even take up these questions and send you emails with our replies on this front. Sorry, it took a lot longer than what we had expected. Very good that there are a lot of questions coming in. It also helps us and also makes us feel good that okay, people are interested in the subject, and it's important that as Tally, as employees of Tally, we know okay what's happening on the indirect tax regime in the country. Thank you for attending. We will address the next 4 or 5 questions. It will help if guys who put on questions in the last 10 minutes, if you can send out questions to either me or Shiv, satya.pramod@tallysolutions, or shivdat.b@tallysolutions, or even write to gst@tallysolutions. And we will try and answer them as soon as we can. Hopefully by tomorrow. Thank you for attending, guys. If you want to again get more clarity and listen, we are doing the same session tomorrow also. Tushar, from 3 to 5 then. 3 to 6. So seeing that we took almost 3 hours today, we will schedule that session for 3 hours tomorrow. So from 3 to 6 tomorrow we'll run the same session. If you want to again listen and get more clarity, it will help if you can run us through the questions, or come back and listen and ask us questions. We will try and provide clarity there. Really sorry, running out of time. We will see you again tomorrow at 3 o'clock in case you want to. Thank you. Can I get these questions? Just